Shopify's earnings, or more specifically, their guidance, confirmed what we've already known and talked about over here on the Investor Channel, and that is the United States economy is in a recession right now, and it's probably going to get worse before it gets better, and we'll talk about that on today's show in the context of Shopify's earnings. What is going on, investors? Hopefully, you guys are doing well out there. Time to talk about Shopify, ticker symbol SHOP. The once high-flying e-commerce site is now down big time. Year to date, is that right? Down 70%. This stock over the last 52 weeks was as high as $1,700, and it made a new 52-week low, trading closer to $400 after reporting their Q1 numbers, which came in. We had revenues of $1.2 billion. I tell you what, you got a $57 billion market cap on this one. My guess it's lower than that. It's probably south of 50 now after today's drop, but you can't grow at 21%, miss expectations by 40 million, and put up stinker guidance. But that is the trend that we've seen with all the e-commerce sites. And what does that add up to, folks? When you drive around California, I'm seeing gas stations, $6, $6.29, $6.30. Drive to expensive parts of California, you're seeing gas approaching $7 per gallon. And we are seeing evidence when we looked at Amazon's earnings. What did they do? They gave us guidance for the second quarter that said revenues are expected between 116 and 121. Guess what? The street was expecting 125. And folks that are new to the stock market, when the street is expecting 125, they're throwing Amazon a bone. They're expecting Amazon to come in at 127, 128, and then Amazon guided between 116 and 121. So they missed even the softballs that Wall Street throws at these companies. That is showing you that consumers are pulling back on their discretionary spending. How else do we know this? We got eBay's earnings last night. They came in with their guidance for the upcoming quarter between $2.3 and $2.4 billion. Again, the street throws these companies a bone. They were expecting eBay in Q2 to do 2.5. So instead of doing 2.5 billion, they're expected to come under 2.4 billion. How do we also know this? We come over to Netflix as well. Revenue for the Q2 expected to be $8.2 billion. The company's expecting now closer to $8 billion. I tell you what, if people can't afford a $12.99 Netflix subscription, a consumer is not doing well. And how do we confirm this? Is people are shopping at the discount stores and they're taking their last dollars to the place where they feel that they get the most bang for their buck, and they're going to Costco, because April comparable sales over at Costco actually grew 12.6%. You are going to see over the next couple of months, companies like Costco, companies like Walmart, even probably companies like Target as well, Dollar Trees, they're going to have their sales hold up a little bit, because that's where consumers are going to take their last dollars, because they're dumping it all into their gas tank, the grocery bill. All the inflation is hitting this economy, and we're seeing it based on the earnings estimates starting to come in on Q2 guidance from Netflix to eBay to Amazon, and now Shopify gave us their guidance. They said full year 2022 revenue growth to be lower in the first half, otherwise meaning we're going to miss expectations in the first half, and they say highest in the fourth quarter. Well, no kidding. But the biggest question investors should be asking themselves now is, now we're looking past Q2. We already know gas is $7 a gallon. We already know the consumer is starting to pull back on their spending. They're not getting the stimulus checks they once did. They're not getting the type of government handouts that they did for the last 2 years. Those days are over. And now we have to start asking ourselves, is Q3 and is Q4 gonna come in? Because if Q4 and Q3 is a miss from Shopify, Amazon, eBay, Netflix, guess what, folks? These Japanese steak knife formations on these stocks are going to go even lower. The valuations and the multiples are just going to continue to go lower and lower and lower, because I'm looking at Shopify's estimates. Again, this is based on Wall Street's estimate here. They're expecting $1.4 billion in Q2. That was 27% growth. Again, they just missed their Q1 by $40 million. Q2 is still set at $1.4 billion. My guess is in the coming days, that is going to likely come in. Again, Q3 expecting close to $1.5 billion worth of revenue estimates. That's 32% growth. You think Shopify is going to grow 32% year over year if gas is still $6 a gallon in Q3? I guess not. And finally, Q4, they're expecting 1.86. That is a wild card quarter. Obviously, you have the holiday season here in the United States and around the world. But if gas continues to be $6 over the course of this year, guess what? People are going to have way less money. I mean, we're talking way less money to spend in Q4 on gifts. And my guess is those earnings estimates are going to come in. And that is going to be the story that we're going to watch over the next couple of quarters, because inflation and high prices are taking its toll on consumers' discretionary spending, and Shopify's results show that. Now, $988 on the revenue side last year on a quarterly basis, up to $1.2 billion. We're seeing those margins start to contract as well, because you notice on the cost side, we went from $429 up to $565. Again, you'd assume the cost go up year over year when your revenue grows like this, but they are growing a little bit faster than the revenue growth. So we got gross profit going from $588 million up to $637. That is the sexy thing about Shopify. These are pretty healthy gross margins. You've got $1.2 billion and you've got $637 million in gross profit. But again, look at those margins start to contract. Last year, you were at $988. More than half of that flowed down to the gross profit side at $558. Now we're seeing about half of it is flowing down to gross profit. Those margins are starting to compress. Now, what also is not compressing are other operating expenses over at Shopify. Look, across the board, everything going up. And look at our operating expenses from $439 to $735. Oh no, last year we made $558 on that gross profit side. We minus off $439 million. So we had an income from operations at $118. A lot of people thought this company was turning the corner at that time. Certainly the shares were a heck of a lot higher. Now look what happened. We made $637 gross profit, but now we've got a minus off our operating expenses of $735. That gives us a loss from operations at about $98 million. That is a problem. So you've got the consumer under pressure. Basically, every e-commerce site that reflects discretionary spending from consumer, they're all guiding down for Q2. If gas and inflation stays high for another couple of months, these companies will come back in about 3 months and say, yeah, we're going to miss in Q3 and Q4 probably, and those stocks will continue to go down, and we'll see companies like Costco gobble up the vast majority of consumer spending because they simply don't have any money left over. From the balance sheet perspective, company has plenty of cash, okay? They can ride through this wave. They can handle some losses. They don't really have a ton of liabilities other than a convertible note, which if you assume will convert to equity, will likely dilute you as a shareholder. Also, another thing that's a problem, in my opinion, with Shopify, we come down here to cash flows. We pull down a disastrous net loss number of $1.4 billion. I say it's disastrous because look where you were last year. You had positive net income of 1.3. Now you're negative 1.4. But look what the executives over at Shopify did. They made $69 million worth of stock-based compensation in 3 months. That's not for the whole year. That's not for their whole life. In 3 months last year, on $1.2 million worth of positive net income, they rewarded themselves about $70 million. Well, look what they did this year. They swung from a net gain on the net income side all the way to a net loss. And guess what they did? Instead of paying themselves $69 million in stock-based compensation, oh yeah, it went up. It went up to $117 million. Are you kidding me? I guess that's what you can do when your stock is one of these high flyers and people just pile into it without even looking at the numbers or the multiple. Well, those days are going to dry up really fast, and the people over at Shopify might be having to dust up their resume, because if you continue to put up quarters like this and have executive compensation that high, that is not going to fly with investors for that long. Now, from a cash flow basis, also painting an absolute disaster story for Shopify. Went from a positive cash flows of $135 all the way to a negative of $53 million. Everything else about what you'd expect from a cash flow perspective. And all of that adds up to the fact that this company has swung from a net income to a net loss, to margins drying up, to missing guidance, to Amazon, to Netflix showing weakness in this economy. And yes, folks, the technical term for this is a Japanese steak knife. This is a falling knife, and you do not want to catch it. There are some areas of support that we've had marked out here for a long time with Shopify. You can go back and look at my old videos on Shopify. We're down here at about $300 per share. That'd be the first stop that I see this stock making. I would not, and I repeat, I would not touch this stock with a 10-foot pole before you got to about $300 per share. Even then, the valuation, in my opinion, is a little rich. And then when we look at these estimates that the analysts still have on Wall Street, again, this is the softball estimation for Shopify's upcoming revenue estimates. The street is still expecting 27%, 32% growth, and 35% growth for the upcoming 3 quarters respectively. Does anybody believe this company is actually going to do that if gasoline stays at $6? I don't, and it's nothing against Shopify. This is the same way I feel about Amazon, eBay, Etsy, Netflix, any of these companies where consumers are discretionarily spending their money. It's simply not going to happen when inflation is just eating up all the extra dollars that they have. The other thing that this is bearish for is Facebook as well, considering the vast majority of Facebook ads try to convert on a Shopify store. People are not buying goods. Well, then people are going to be buying less ads for those goods. I think this is bearish for both Facebook and Google going forward. Again, we're looking out 2 or 3 quarters. And in my estimation, despite the massive drop we've seen in a lot of these stocks, I still don't think the stock market has a miss on Q3 and Q4 priced in. And then if you stretch it out into Q1 23 or Q2 23, well, the stock market's probably got a long ways to go down. Again, if you don't want to hear the truth, if you don't want to hear reality, tune in to the dozens of other YouTube channels that are here only spouting good news and positive things about stocks that are down 70% year to date. There is nothing good about a stock down 70% year to date, and the executives going from $69 million in stock-based compensation to $117. If that doesn't make you angry as an investor, stop investing in individual stocks, stick your money in the ARK investment fund or some ETF and let somebody else manage your money. This is atrocious. This is probably going to get worse. And if you don't realize it, you need to get with the picture very quickly because the data is not lying. A lot of you are going to get down in the comments and say, I disagree with you. I disagree with that. You're not disagreeing with me, folks. This is what the data is saying. This is what multiple companies are saying through guidance, and this is what the financial statements are saying. Sorry to be the bearer of bad news, but that's where we're at in this economy. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.